The bank reporting season has kicked off today with Bank of Queensland posting a half-year net loss of $91 million compared with a net profit of $48 million the previous year, and impairment charges of $328 million reflecting the bank's heavy exposure to Queensland since the floods. The result was no surprise, flagged recently when CEO Stuart Grimshaw, 5 months into the job, took steps to shore up the balance sheet with a $450 million share raising after a review of the bank's property portfolios. Well, I caught up with Mr Grimshaw just after BOQ's media conference. Stuart Grimshaw, welcome back to the business.
Thank you.
Well, a disappointing result, and most of it's pre-announced, of course. But going back to your review, presumably you must have been quite shocked at what you found there, which then led to these changes in impairment levels and bad debt levels.
Yeah, no, it was. I think it's quite ironic because we operate fairly much in the Gold Coast, Sunshine Coast, southeast Queensland type markets, and what was surprising was the extent of property value falls that we actually did see in a very short period of time. And typically when you look at the BIS shrapnel type results, they always talk about the major capital cities, and we really hadn't seen that fall in values. But when we started seeing some of the realisations on property coming through, it really triggered us to have a good look at the loan book and the age of valuations to assess how, well, we basically did a mark-to-market of the book.
Well, the moves in the market may have been quite extreme, and I understand normally, say, a 2-year valuation on property would be okay. But a year ago, say, why shouldn't the mark-to-market have happened then?
Oh, it's a good question. I think a new CEO sort of brings a different approach to it. I think every major bank has their own real differences, and I think a 2-year-old valuation policy is pretty standard across most banks, which wouldn't cause you some consternation. But I think what triggered it most was when I started to see some valuation changes come through, which gave me the opportunity to look at the book and say, well, what is happening? And I also have a bit of a view. I don't think property is going to improve for a while, that we should look at it and deal with it while we have the opportunity. I don't think the triggers were in place about 12 months ago. I just sort of got a bit alarmed at some of the rapid changes in value that we did see.
I thought a good analyst question this morning was about Morningstar's comment, and that the problem was really David Liddy's legacy, that the outgoing CEO was focused more on getting a good profit rather than the quality of the balance sheet.
Oh, look, I can't comment on that. I'm just dealing with what I've got, and really what we're doing is setting the bank up going forward. I believe that the policies and processes in place were exactly the same as every other bank. From what I understand, that's just a personal view. I haven't objectively looked at that, but certainly having worked in a number of banks, the policies that we have in place are quite consistent. I think the thing that is different is the amount of concentration we do have in the Sunshine and Gold Coast.
You've had the downgrade by Moody's now. Are you confident that your strategy will deliver? Because you're not Robinson Crusoe here. Every bank seems to have the same strategy in terms of growing retail deposits.
Yeah, no, that's correct. I mean, we do look at the fact that we are very local. We have people who have been local for a very, very long period of time. They are parts of the community, but having said that, you do have to price the deposits appropriately to get the money. We've shown over the last 12 months that we can grow retail deposits quite strongly, outperforming 1.3 times system, and I think we have the right people to continue to grow it.
Now, as an incoming CEO, you've strengthened your balance sheet, you've booked the losses, you've got this growth strategy and indeed a dividend growth strategy. If the growth doesn't eventuate, will you still be sticking to the dividend payouts, even though that might mean running down the quality of your balance sheet again?
Oh, I think that any dividend policy is one for the board and not one for management. I think all you could look at is the fact that we paid a dividend at the same level as the prior corresponding period, the first half, means that the board are very, very committed to ensuring the dividend is at a level that reflects the quality of the business, and they do believe the business has an ability to grow well in the future.
Just one on interest rates. Are we to expect more out-of-cycle movements, including from Bank of Queensland? Because I know this is something that you feel that your customer base doesn't really understand.
Yeah, we've been quite strong in saying that we would move with the RBA in terms of any announcement being on the timing of that. I think people actually understand when the RBA meets what the outcome is, and they can link movements to that. I think it's a very complex issue to start grappling with wholesale changes in the cost of funds on a fortnightly basis. We think that by going with the RBA, and we have in the past moved very quickly, we've given customers certainty. And one of the things we're trying to do differently is actually understand what our customers' needs are and try and manage them as best we can, which is why we're doing what they understand.
Now, today we've had Industry Funds Management Chairman Gary Weaven saying the RBA's approach to inflation is now totally inappropriate. And that's come on top, of course, of Paul Howes pushing the government to review the RBA's charter. What do you make of all this?
The only thing I could say is there are a lot of people with free advice, and which seems to mean it's a very hard job that the RBA is doing. I mean, if you look at the two-speed economy we're running, Queensland and WA have very strong growth prospects through the resources. The employment numbers most recently mainly was driven out of Western Australia in the mining sector. Victoria has been suffering. You've got the carbon tax coming in, which is probably going to be inflationary in its first phase. I think it's a very difficult job to actually dictate where interest rates should go or what's best for the economy and who's best to make them.
So these fellas should just butt out of RBA deliberations?
Well, it makes news, Ticky, and we're talking about it, so it must be good for you.
Stuart Grimshaw, you seem to have drawn a firm line in the sand in this last quarter for Bank of Queensland. We'll watch you with interest. Thank you for joining us.
Thanks, Ticky.